Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing, guys, the company AbbVie, a company that, well, it's a favorite to a lot of dividend investors and including myself, honestly. They pay me a nice juicy dividend pretty much every single quarter, and seeing, guys, that their earnings are actually coming out on Friday before open. You only have before open on earnings on Fridays. Let's analyze this company based on their fundamentals, use discounted free cash flow to see if maybe at the current share price this might be a pretty decent buy. So with that said, let's get started with this analysis. First of all, guys, I'm actually fairly excited to analyze this again because, well, this is one that I've only analyzed one other time. And, well, I did update the calculator a little bit here and there, right? I added a couple things. So I'm actually very excited to see what these metrics actually look like. Current dividend yield, guys, of 3.73%, which is $1.41 per share for an annual payout of actually pretty big, $5.64. Payout ratio, guys, in regards to the net income is also fairly small, even though this annual payout is massive, right? Of 41.98%, essentially 42%. And what's even more impressive is this 5-year CAGR on this dividend, right? A whopping 17.46% with 9 consecutive years of dividend growth. That's actually fairly good, guys. The fact that on the payout ratio that we're looking at it here, their 5-year CAGR is still 17.46% with 9 consecutive years is fairly good. So if they continue the same CAGR in the next couple of years, then you are probably getting an even higher dividend at that point, which is really solid, right? Now, does this mean that they can afford it? We're going to take a look at this in regards to the cash flow, right? The payout ratio in regards to the cash flows, 5-year average, and last year to see if they can actually afford this, because we just saw what happened with Rio Tinto, that they cut it. We want to avoid these kinds of things, right? As dividend investors. Now, ex-dividend date, guys, passed as of July 14th. Payout date was August 15th, and they pay their dividends quarterly. Now let's come over here, guys, to the spreadsheet. We got the ticker symbol of ABBV, market cap of $264.6 billion, PE, guys, of 21.48. So that's actually pretty big, but the fact that the PE is 21.48, I like to buy 20 and under. You know, the problem is that you're actually fairly close to that 20 mark. So with a current share price of $149.75, well, you might actually be willing to pay this premium of 1.48 points when it comes to a PE. But PE is only one thing, guys. Let's take a look at other metrics later on to see if maybe we can actually buy this company now based off of their future cash flow. Now, looking further into this dividend, guys, current annual dividends per share, as we saw, is $5.64, which actually ends up being almost $10 billion in dividends being paid out every single year in regards to the amount of shares outstanding that they currently have. Now, this is important because looking at their 5-year average free cash flow, after this dividend is paid, they're still left with around $4.8 billion. And looking at their last year's free cash flow, which, by the way, I don't think we had this one when I first analyzed AbbVie, well, they're still left with $12 billion as of last year's free cash flow. So this is actually fairly interesting. Last year's free cash flow's payout ratio is actually 45.32%, whereas the 5-year average is 67.54%. So now you have two scenarios that last year's free cash flow is under the 60% that I like to follow, whereas the 5-year is above the 60% that I like to follow. You have to take it here with a grain of salt because, well, I don't necessarily know which one to follow, right? Last year's or the average. The average tells you the whole entire story, whereas last year's may have just been a fluke. So I don't necessarily know, but as it stands, guys, if they do have a CAGR of around 17% and the 5-year average is 67, this might actually be in territory for it to be cut. But that doesn't necessarily mean so, right? Because if they continue to grow their cash flow and if they are buying back shares, then obviously this cash flow, this payout ratio to cash flow will actually come down in the future. Now, guys, let's analyze some fundamentals, starting, of course, with the net income 5 years ago of $5.3 billion to 1 year ago of $11.5 billion, increase of 117%. And, well, I gotta say, guys, aside from this off year, which was 2 years ago, we all know what happened, you know, during COVID, sure. We expect the net income to come down here. Aside from this year, guys, 3 years ago, really solid, right? Staircasing going upwards, nice, increasing steadily, and you know, they did bounce back a really good amount from this drop, going from 7.8 or essentially 7.9 billion dollars 3 years ago to 4.6 billion dollars during COVID, and then a massive jump to 11.5 billion dollars. That's fairly good in my personal opinion. So even though this is an off year, essentially ignore it, guys, because it was a COVID related number. Now let's take a look at the free cash flow, the most important profit metric that we have, because guys, cash flow drives essentially everything. It is what a company uses to pay down their debts, buy back shares, pay out a dividend, which they pay out a dividend, right? To make acquisitions and to overall grow the company. So cash flow, it is very, very important, and you want it to be, first of all, positive, and second of all, you want it to be increasing nice and steady. 5 years ago of $9.4 billion to 1 year ago of almost $22 billion. That's an increase of 133%, with a 5-year average of $14.75 billion. Guys, that's actually looking not too bad. Even during COVID, they still went up in their free cash flow. Now, what is kind of peculiar here is that from 4 years ago to 3 years ago, they actually dropped, believe it or not, right? They went from $12.789 billion to 3 years ago of $12.772 billion. Tiny drop, but a drop nonetheless. I don't necessarily know what happened here, but I think that it was just like a fluke year maybe, because they did bounce back very, very nicely after that, right? So when it comes to this is looking as well really, really good. And now guys, looking at the revenue, 5 years ago of $28.2 billion to 1 year ago of $56.2 billion. That is an increase, guys, of 99.17%. And well, we actually see something somewhat similar to that of the free cash flow, whereas 4 years ago and 3 years ago, they did go up slightly, right? Whereas the free cash flow, it slightly went down, but it was so close to each other, guys. You can't even tell the difference in these two graphs right here, right? But they did bounce back very, very nicely, even during COVID, to $45.8 billion. And then today, as I said, $56.2 billion. So nice increase, and it's also staircasing as well. All right, guys, now let's head over to the total assets minus the total liabilities. Fun fact, the first time I actually did this company, we actually did not do total assets and total liabilities. We did total current assets and total current liabilities. So I was actually kind of perplexed when I saw this graph, because I'm like, I don't think this is what I saw last time, but that pretty much explains that. But nonetheless, guys, total assets minus the total liabilities. This one pretty much just tells us if the company is able to survive a recession. Are the company's assets able to supersede their liabilities, in hopes that they may be able to subsidize their liabilities with their assets? So currently, guys, they are at $16 billion in this difference. Now, what is fairly surprising is, well, the fact that 4 years ago, they were in the negatives for this difference of negative $8.4 billion and negative $8.2 billion. This actually falls in line, guys, with what we've been seeing here, right, with the revenue as well as the free cash flow, that these 2 years, for some reason, when it came to these kinds of metrics, except for the net income, ironically enough, but when it came to the free cash flow and the revenue, these 2 years were definitely off years. I highly suggest you guys go figure out what caused this, right? But as it stands, guys, the fact that, you know, they bounced back really nicely 2 years ago during COVID, and they continue to increase it, really, really good. Though, again, kind of concerning that it was 2 years in a row, and not just, if it was one, I'd be like, okay, fluke, whatever. But 2 years in a row is something that I would highly suggest you guys look into. But nonetheless, as it stands at $16 billion, they're able to cover their liabilities. Average total assets is around $110 billion. Average liabilities around $104.3 billion. And doing this difference, guys, we get $5.6 billion. And now let's actually take a look at the metric that, once again, I did not have when I first analyzed this company, and that is the cash flow minus the total liabilities. As I said when we were analyzing the cash flow is what companies use to pay down their debts. So it's really, really important to see if, you know, okay, sure, their total assets can't cover their liabilities, but can their cash flow cover their liabilities? That's the next one, guys, right? So what I usually find is that most companies are in the red when it comes to this metric, but what I'm trying to look for is, are they getting closer and closer to zero? Meaning, is their cash flow increasing and their liabilities decreasing, right? That's essentially what I'm looking for. And obviously, if this number is positive, then that's even better. But as it stands, guys, they are way deep in the red when it comes to this, reaching the low point 2 years ago, which is not surprising, right? But reaching the low point 2 years ago of $120.7 billion in the red, right? Negative negative $120.7 billion. And then 1 year ago, they did bring it up a little bit to $109.1 billion. But overall, the trend has been pretty much going down. Obviously, the more years that pass, we will see if maybe they'll continue to get this number closer and closer to zero, but as it stands, it is pretty much going further and further red. Average cash flow minus the average liabilities, we get around negative $85 billion. And now, guys, let's analyze the metric that companies tend to fail, unfortunately. And even companies, guys, I mean, you guys are looking at it right now, right? Even companies that are huge, that make pretty good money, that have a really good cash flow, sometimes they even fail this as well. Shares outstanding, guys, it is a metric that you want it to be decreasing, not increasing, right? Because the more shares that they buy back, first of all, the less dividend they have to pay out, which is just amazing, and the less dilution of the investor they're actually giving, right? So you essentially want shares outstanding to be going down just overall, right? Shares outstanding, really important metric that tends to be overlooked, and you want it to be decreasing. Now, unfortunately, when it comes to AbbVie, 5 years ago, guys, they had around 1.6 billion shares outstanding to today, guys, of 1.76 billion shares. In the 5 year, this is a massive increase of almost 11%. And from the previous year to the current year, they are buying back a little bit at 0.08. This is looking at 1 year ago at 1.768 billion shares to today, guys, of 1.76 billion shares. So this is actually kind of disappointing to see. But I do have to point something out, though, and that is that if you take a look at the shares outstanding from 5 to 3 years ago, they were essentially decreasing. Now, we did have a little bit of an increase from 4 to 3 years ago, but it was minimal. However, after 3 years ago, 2 years ago, basically when COVID happened, they ramped up those shares, right? That's essentially what's been happening here. And ever since then, well, they did issue shares from 2 years ago to 1 year ago, but then from 1 year ago to today, they bought back a little bit. I don't necessarily know, guys, but nonetheless, I think the reason why they increased shares is because of the COVID, right? A one-time thing, but nonetheless, they still did it. And well, if you guys are watching this on the 29th, let me just all remind y'all, we did get GDP numbers for Q2, and it is official, we are in a recession. So now I have to take into account recessionary pressures on top of the fact that they just issued shares 5 years ago at around 11%. I have to take that into account when I make my assumptions. But as it stands, guys, this is a negative metric right now. And lastly, looking at the cash and equivalents, they currently have around $6.1 billion with an average cash of around $13.5 billion. And now, guys, it's time to make some assumptions, low, median, high, as always, using the revenue growth, predicted share buyback, and of course, the required rate of return, which I like to keep flat at 10% to match the S&P 500 on average. So let's make some assumptions for the revenue growth. Coming over here to Seeking Alpha's growth tab, we can see that the revenue growth forward is at around 6.88%, and the revenue growth year over year is 13.01%. So taking a look at these numbers, guys, my job as an investor is to be conservative, and I have to take into account the fact that we are officially in a recession as of today, which is July 28th. We got 2 consecutive quarters of negative GDP. We are in a recession. So I have to take this into account, and I have to think, hey, how will this company be able to handle this recession, right? Sure, COVID was a recession too, but it was such a flash recession that it wasn't even funny. It was quite possibly the shortest recession ever. But I personally don't think that this one will be that short. We'll see what happens. But nonetheless, I have to take that into account. So for my lowest assumption, guys, in terms of revenue, let's say that they make 4% for the lowest assumption. For the median assumption, let's bring this up to 6%, and for the highest assumption, let's bring this up to 8%. Now for the predicted share buyback, guys, they did issue shares because of COVID, and you know, I understand that because that was unprecedented. But right now we're in a recession, so I have to take this into account as well. Therefore, I'm going to say that within the next couple years, guys, that they'll pretty much issue the same amount of shares, maybe a little bit less. Let's say at around, like, I don't know, negative 9% or so, right? For the median assumption, let's say that they'll issue a little bit less than negative 9 because it'll be slightly better, right? And let's say negative 7%. And for the highest assumption, guys, let's say at negative 5%. Now that we have all of these assumptions, guys, we can see that we do have some target share prices, not adjusting for debt as well as adjusting for debt. So for the low assumption, not adjusting for debt, we get $169.78. For the median assumption, it is $185.50. And for the high assumption, it is $202.50. None of this is just for debt. This is why we take a look at the cash and equivalents as well as the net debt is something that you guys have to fill out. And if they have more cash than debt, then this number comes up. And if they have more debt than cash, then this number comes down. As you can see, it does come down by around $30 or so, which is actually fairly interesting because, well, this pretty much puts us in a pretty good buying area, right? For the low assumption, it is now at $138.71. For the median assumption, it is $153.82. And for the highest assumption, guys, it is $170.19. Now let's add a margin of safety, guys, of 5, 10, and 50%. And in doing so, this puts me to within a buying range for the low assumption of around $118 to $131.78. For the median assumption, it is $130.75 to $146.13. And for the high assumption, guys, it is $144.66 to $161.68. Guys, the current share price is $149. So what does this tell us? Basically, that for the target share price, it's not adjusting for debt, it's an all-out buy in every single scenario, right? But take a look at this. In the target share prices not adjusting for debt, only some actually tell us that this is a pretty good value, right? So basically, for the low assumption, you would still have to wait for it to drop around $10 or so and a little bit more because of the margins of safety, right? But for the median assumption, we are essentially almost there, right? With the target share price adjusting for debt, we are at $153.82. Guys, $149. Again, maybe this is a kind of premium that you would like to pay for, right? It's only about $4. It's not too bad. But now with this margin of safety of 5%, well, this puts us below the current share price at 146. But then again, you may want to take the same approach as to like, it's close enough, let us just go with it, right? And when it comes to the high assumption, we can see that two of them are pretty high. However, looking at the 10% margin of safety and the 15% margin of safety, we are essentially between these two guys. So again, that might be something to consider as to buying the current share price of $149. So this is essentially what this is telling me. Maybe it is a good buy right now, but guys, but as always, you guys should make your own assumptions because this isn't financial advice and every investment is the present value of all future cash flow. That's why I have this calculator available for free. Anybody can have it. It's in my calculators playlist. There are videos there showing discounted free cash flow update and discounted free cash flow. It doesn't really matter which one you go to. The link in the description should lead you to the same spreadsheet because they're both linked to the same spreadsheet. So any updates I make will show up in both. You guys can have this calculator. You go in there, you come up here, you go to file, make a copy, boom, you have it. I also have, guys, my book value calculator as well. It's not really a calculator, it's more like a ratio, but nonetheless, you guys could use it. I also have a re-evaluation calculator, which I probably will make a video this weekend knowing how to use it because I did change it up a little bit. As well, guys, as a dividend tracking sheet, which, you know, I have AbbVie right here, right? I have AbbVie at 66.227 shares. And it pretty much just tells me that AbbVie is giving me, guys, quarterly $93.38. That's not too shabby. So if you guys want to have this dividend tracking sheet, just so that way you guys can track your companies, dividends or not, dividend paying or not, you guys can also have it as well. All I'm asking for in return, guys, for these free things is just like, subscribe, comment. It really does help it with the algorithm on YouTube. Just help me grow my channel. That's about it. Thank you so much for everybody who have subscribed so far. That is insane. 772 as of I'm recording this video. Oh my god, thank you so much. I honestly, like, thank you so much. It really does motivate me to make more videos. And by the way, I will get to more of your recommendations this weekend. It's just that this week, guys, has been crazy when it comes to earnings. It always is, so it's just what it is. I promise this weekend I will get through all of your guys' stock picks, so be on the lookout for that. As well, guys, I also want to do something very, very special, but I'll tell you guys about that towards the end of the video. But all I'm asking for in return is like, subscribe, comment, just help me grow my channel. Thank you so much. Let's see if we can make it to 800 by the end of August. That would be awesome. Now, guys, let's analyze this dividend a little bit further because AbbVie is a company that people tend to buy for its dividend, and seeing that in accordance to my target share prices, I might consider buy it. Well, I want to see how much this company will pay me if I were to put in 1 month's income at the average US income per year, right? So this monthly income comes out to be $5,725. And at the current share price, which apparently it's a decent price to buy it at. This buys me 38.23 shares, and the current annual dividends per share, guys, look at this. This company will pay you $215.63 in annual dividends, $53.91 in quarterly dividends, and $17.97 in monthly dividends. That's actually really, really good. I always say anything above $200 annually for $5,725 is a pretty good value, but me personally, guys, I like to be efficient when it comes to my dividend purchases. So if we would actually put here $2,000, which is what I normally like to invest per investment, right? $2,000. I like to see if maybe they'll pay me $100 in annual dividends. So as you can see, we're shy off of the $100 in annual dividends by around $25 or so. But nonetheless, guys, it is still a fairly decent value, $2,000, and you get back $75 every single year. That's actually not too shabby. And hopefully the more this thing falls, we'll see, we're in a recession right now, the more this thing falls, this annual dividends will go higher and higher and higher. But that is essentially that, guys. In my personal opinion, it's not a bad company right now to buy for annual dividends. It's really, really good. All in all, guys, final thoughts on this company is that, well, I own it, right? I just showed you guys that I own it and I love it. I hate myself because, well, I actually started buying this company when it was at $80 during COVID, the bottom of COVID. Yeah, I got scared. I didn't buy anymore. It just goes to show, guys, that when things go down because it wasn't the company's fault or whatever, right? It was some external factors, you have to take advantage to buy it because, oh my God, I would be getting so much more money in dividends from AbbVie if I would have just bought more. So unfortunately, it is what it is. We'll see if they ever go back down to $80 or so. But, you know, if that opportunity comes, yeah, get ready because I probably will be making a video of me buying several $1,000s worth of AbbVie. But guys, that's pretty much it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my new tech sites, link in the description below. And well, guys, this is the last day for earnings, or at least for this earnings week, right? Probably one of the biggest and most anticipated earnings weeks. And I do plan on finishing all you guys' stock recommendations, still have a little bit more to go. But I actually wanted to do a very special video on Saturday morning. Maybe even not a video, I'll probably do like a live stream of it. I don't know, I haven't decided yet. But basically, guys, I want to take a look at what happened with Intel today and their earnings call because yikes, it was not good. And well, what happened? It's an example of how to, okay, I thought a company was going to do this. It actually ended up being the complete opposite. We must reassess. I want to show you guys how to do that, or at least how I do that, just so that way you guys learn how to reassess investments when things change. So be on the lookout for that video, guys. It was really, really awful what happened today with Intel, so be on the lookout for that video. But that pretty much does it. Peace out, and I will see you all in the next stock analysis of video.